So you hope to become an entrepreneur. How do you plan to fund the venture, and will the market accept your ideas? Now, lack of attention to such critical issues often results in business failures. On October 23, 2013, Mayberry Investments' monthly investor forum focused on the relevant and timely theme, entrepreneurship, financing your business. Paul Chin, who is the credit manager at the Jamaica Business Development Corporation's Financial Services Unit, explored several funding options, including debt financing.
The upside to debt financing is you don't have to give up a stake in the business. Most persons in Jamaica tend to be very cagey as it relates to their business and having other people involved in their business. The downside to debt financing is there's a cost to borrowing, and that cost is interest. And as we all know, interest rates, whilst not as high as they were several years ago, are still not at a level that they ought to be.
Grant funding is one option. However, Chin warns that those opting for this route should do their research.
From time to time you hear people talk about grants. Now, a grant is non-repayable funds. It's free money. There's a catch, however. Grants are designed to fuel small businesses, yes, but getting a grant is very difficult sometimes. You have to do your research. You're not likely to see grants being published in the newspaper as readily as you see course advertising. You have to search, you have to go online. There are certain agencies which are always, well, perhaps not always, but will from time to time provide grant financing. There is CEDA, CEDA, short for Caribbean Export Development Agency, and there's also CIDA, CIDA, Canadian International Development Corp Agency. The upside, as I mentioned, is free money. Downside, it is highly competitive. Grant institutions will require you to jump through hoops in order to get their grant financing. And they are usually very strict as it relates to how they define what you can do with those funds. And in some cases, grants are considered as reimbursable grants. So you have to spend money up front and then you get reimbursed at the back end. So for a lot of small businesses, that doesn't really help. But the fact is, it is free money and it is out there. You have to do your research.
Smart business owners are realizing that it's better to own 51% of a larger business than 100% of a smaller business, and that's where equity financing comes in.
No, equity is an investment in exchange for a part of the business. And equity financing has a number of upsides and downsides. Equity can be more convenient. It comes with less strings attached. And it is perhaps more available more quickly. The downside to equity financing, however, is it is usually a limited one-time source of funding. You can't keep going back to the equity investor asking for more money. So you need to be certain of what it is that you want to do, how much you're going to need. So when you make that approach is a one-time approach, and you know exactly what you're going to do with the funds. And that is where something like a business plan will come in very handy. Perhaps the major downside is equity can water down your ownership of the business. Equity financiers usually ask for a stake in your business. So you must be prepared to give up 10%, 20%, perhaps 25% of your business operations. But at the end of the day, 75 or 80% of something is better than 100% of nothing. So it is always a good idea to try and get equity financing. It is also cheaper than going the route of debt.
Some with sound business ideas court venture capitalists. So what does a venture capitalist bring to the table? Audrey Richards is a project consultant at the Development Bank of Jamaica. She focuses on the development of the Jamaican capital market for venture capitalists, and today she gives a snapshot of what a venture capitalist brings to the table.
A venture capitalist brings smart capital, funding, managerial and technical expertise, new technologies and ideas in a lot of instances. Particularly, one of the things that we are looking to do is to tap into a lot of our diaspora members who actually are in this asset class or working in this asset class, possibly some of those in Silicon Valley or Boston or wherever, because a lot of our young entrepreneurs who are involved in ICT need that kind of mentoring and linking or investing from venture capitalists or from persons in the technology area who can actually help them to come up the curve in terms of their business and their knowledge. Now, what do venture capitalists require? They're taking high risk. So they're looking for high potential enterprises. Venture capital is not for every company. There are some companies, some entrepreneurs that you've set up a business and you're quite happy to continue as a small business and you own your own boss and so on, and you're not necessarily, you're having a steady market and you're comfortable, and that's fine. Not everybody wants to necessarily scale up and become a national, regional, or even a global player. The venture capitalist is looking for those that the business model has the potential to become national, regional, global, and the entrepreneur, the investor himself or herself, has that passion or has that desire to actually take the company to another level. So not everybody's venture capital is suited for everyone.
As ambitious young and indeed older Jamaicans opt to go into business, it's important that they find the correct funding fit. Finding the correct funding fit is perhaps one of the smartest moves they could make. And that's your wealth for this week. I'm Owen James.